Welcome to the sharpening session. Today is January 8, 2022. My name is Josip Causic, and I apologize that we had a little bit of the technical hiccup at the beginning. My email is provided right here on the slide. And please take a moment to read the disclaimer. And let me show you another place where you can get in touch with us at traddictiv. After the session, I will be posting the notes right here in this area. Trade with the UFOs, ask the questions, and there will be agenda that I will be presenting to you throughout this hour. And I want to just emphasize one thing that is well known, that 20% of our activity produces 80% of result. So again, what does that mean? The actual trades that we place produce 80% of our result. So the 20% of our activity is what matters. The other is just preparation. So what my agenda is over the next few minutes is simply that I'm gonna bring the document here and I'm gonna spell out the agenda overview. And this agenda overview is gonna include going over the charts. So I'm gonna going over the charts of the 4 major markets. And in fact, I will share with you the workspace that I have created on Thinkorswim back in 2006, and I still use it till this day. And it involves looking at the Russell, it involves looking at the QQQ, it involves, of course, looking at the SPY, and it involves looking at the diamonds. So without any hesitation, what I'm going to do right now, I'm going to click the file, I'm going to go new, and I'm going to open a brand new page. So having this is going to teach you how to create the space that you can use, like I have been using for the last 18 years. So I'm gonna bringing the charts 4 times, and once when I have 4 charts, I can simply click arrange it horizontally, and each of these slides, each of these charts needs to be adjusted to display the 4 major markets. So on my Thinkorswim platform, I actually track the futures, but for the simplicity of the sharpening session that focuses on an option, I'm going to actually use an exchange traded fund. So exchange traded fund called Diamonds, it's tracking the 30 stocks of the Dow Jones Industrial Average. And what I'm going to do here, I'm going to actually change it to monthly. So every one of these things that I'm going to pull up, it's going to be on the same time frame. So on the top, I have a diamond, and you will notice when I type in SPY on the bottom and change it to the monthly, the similarity between the Dow Jones that has a 30 stocks and S&P 500 that has a 500 is very, very similar. Yet that is very much not true when you look at the QQQ, which tracks the NASDAQ 100. So NASDAQ 100, again, we're going to be looking at the monthly. And last one that is not looked at by many traders is IWM, which tracks the small caps or the 2000 stocks. And I will actually start my analysis by enlarging this particular chart, and I will go slowly over this, and I want to disclaim a few things here before I start. And the first thing that I want to disclaim is that we're looking at the monthly chart, but we need to be aware of it, that this very last bar is the bar that is only 1 week old. So it's not a monthly because it still needs 3 more weeks, but the point is that this bar is the one that we're gonna ignore it just for a few seconds while I'm doing this analysis. So what I'm doing right now, I'm zooming in on a price action of the last year. So last 12 bars is what I'm looking at here. And I want to make sure that I go slowly on this so I don't lose anybody, because I'm looking at the year and I'm looking here at the price action that encompasses over here January, February, all the way to the December, and excluding this last bar, as I pointed out to you, this last one that I want to talk about. I'll come back to it a little bit later. So what I want to point out to you, that with the exception of market rallying in the January and February, most of the time the market has gone, Russell 2000 has gone nowhere. It was sideways. It was sideways. So when you're looking right here, November high is the one point that I want to focus on analysis of every one of these monthly charts that I'm looking at. So we are covering here a number of things, and one of the things that I want to make sure that I explain to you, and that is that from the IWM chart, the one thing that needs to stay in your mind is that IWM has gone nowhere entire year, but it had made a rally on November, and that rally on November has created the new all-time high. So if you're looking right here, this is a November rally, but then we didn't have any Santa Claus rally, because obviously December we have closed lower than a November low. And I want to make sure that this is clear to everybody, because 20% of activity creates 80% of the results. However, what is really essential that we keep in mind that IWM is going sideways for entire 2021, and November all-time high was in November, new all-time was created. Let's compare this now to the QQQ. So what I'm doing right now, I'm minimizing the chart of the IWM, and I want to make sure that it's clear that I'm going to enlarge the chart of the QQQ. Again, I'm going to make a disclaimer that you should ignore this very last bar that is only 1 week old, but because I'm asking here for the platform to show me the price action for the 2021 monthly, this is inaccurate because this includes only 1 single week. And I'll come back to this point in a moment and emphasize what is the point of this whole thing right now. But as I did with the IWM, I'm going to do it right now. Same thing here with the QQQ. I'm going to produce the square that is going to encapsulate all the price action, and I'm going to purposely cut off here this January monthly, and I want you to observe that it's quite different. QQQ has gone up, but if you count how many red bars in the 12 months we had, you're going to observe we had the 3 red bars in the first quarter of the year. April we are up, May we are down, June, July, August, summer we were rallying, then September was terrible. October we took out the high of the September. November, similar to what we have done on the Russell, we have created the new all-time high, and then in December we actually went through the low of the December. So what is that telling us? This is telling us very simple that the market is not in sync. So the QQQ half of the year had red bars. Okay. Also, all-time high was created in November. So you can say like, well, they're not in sync, but they have one thing in common. And what they have in common is that both the Russell 2000 and the technology have both created a November all-time high. Let's now compare to the one that is being evaluated by everybody, and that is S&P 500. So I'm bringing up the S&P 500 and following very much the same logic. I'm suggesting please ignore the last bar, because once again, this last bar that we're looking right here is a bar that represents only the last week. So that one is what I want you to ignore, because that's not what you need to do right now. You just need to get the picture what we are doing in the context of the 2021 in the January, as soon as I'm done with all the four major markets. So what I'm doing now is again picking up the same kind of approach that I did on the first two and cutting through the January bar. And I want you to observe that January of the 2021, we had a red month. September, we had a red month. And surprisingly, November, we had a red month. This again points out that not all things are the same. We have created a new all-time high on a S&P 500 that tracks the 500 of the strongest company, and in December we have actually closed above it with the conviction, because we did get the Santa Claus rally. We did get Santa Claus rally. So what I'm going to do right now, I'm going to add this piece of information to my analysis, so it will be very clear that the SPY had only 3 red months in the entire 2021. Okay? Only 3 red months in 2021. All-time high of November was taken out in December, and we closed at the new all-time high in December. So you are now looking at this like, wow, no wonder 2021 was difficult to trade, because the IWM has gone nowhere. It has gone sideways. It was very difficult to trade. QQQ has been down like 6 months out of the 12 months, while the SPY was actually the place to be. Well, we're not done yet with analysis. We'll still have a diamonds or the Dow Jones that tracks only 30 of the blue chip stocks, and we're going to proceed on that one. So we're now moving to the Dow, and we're going to use the very same approach. It's really good that we do this when the market is closed on a weekend, because then we can be most objective. We can be the most objective when the market is closed, because in that case we don't have any emotions. And as you can see over here, the degree by which the Dow Jones has taken off is bigger than anything you have seen so far in terms of the analysis. So I'm again asking you to ignore the very last bar. This bar that I'm circling is the one that you should ignore. You shouldn't be looking at this bar. You should just be aware of it, that we are going to use the very same approach as we did before and look at only the last 12 bars. So last 12 bars are going to be the ones that are going to encapsulate exactly price action that starts in January, and we had in the January the red month. Then we had a rally up here. Then we again have another red month. We have a September red month, and we also have a November a red month. Now, what is really interesting to notice that unlike the SPY that had 3 red months, we actually on a Dow Jones had 4 red months. But another interesting thing that you should observe is when you're looking at the high of the November, and I'm going to use the same color I did earlier. This is a high of the November. We had a Santa Claus rally in December, but we were unable to take out the all-time high. These fine differences are going to come into play once when we look for a short trade that we want to, during this session, discover and utilize. So I'm going to add these pieces of information to our analysis that, unlike the SPY, Diamond had 4 red bars. All-time high of November was challenged but not taken out. Okay, now that I have completed this analysis, when I was looking at the point of what was the trend for 2021, next thing I was looking, what was the price action in December versus November. I'm going to proceed now to look at 2022 January bar, and I know this shows up as a monthly, but in reality it represents the week in relationship with the low of the December of the 2021 bar. Now this right here, after you do this for a number of weeks, it becomes more and more clear to you, and then you achieve what I like to call objectivity of observation. And objectivity of observation is probably one of the most important thing for a trader. So not the subjectivity, not the emotions, but the objectivity of observation. So I'm gonna now again put this down in such a way that I will again go with IWM first. And with IWM first, because I would like to make sure that you guys are following me on this properly, I'm gonna mark right here with the red line the low of the December. And I'm gonna now tuck that away, and I'm gonna do that for QQQ. And I'm gonna tuck that away, and I'm gonna do that for the S&P. And I'm gonna tuck that away, and I'm gonna do that for the Dow Jones. So when you're looking at all of these things, every one of them, you will observe that, for instance, one single week in a January on a Russell 2000 has virtually negated what the Russell has done in December. But if you think that is bad, take a look what is happening with the technology sector. Technology sector is just about ready to take out the low of that bar that we had in December. So the low of the bar in December is 377.47. And I'm going to write this down for a moment because I will show you how I actually utilize that by using the Thinkorswim platform and setting up the alerts, but I want that number to be very clear to you. Let's pick up the same number for the IWM. So I'm hovering over the December bar and I'm looking at the low of the IWM, and the low of the IWM is 208.76. If we lose 208.76, observe really what is taking place. in that particular case, if we lose the low of the uh, 208.76, the 10 months of the sideway move have been violated to the downside, and there's a high chance that the price action in that case might start heading where? Lower. However, I want a synchronization. I want all the markets to go down at the same time before I commit myself with the bigger position using options. So what I'm doing next now is I'm focusing here on a SPY. And on a SPY, that same level is quite far away. We haven't breached on a SPY because we concluded the SPY is actually strongest of them all. And in case you have forgotten it, I'm going to show you that in a second. I just need to write down the low of the 448.92. What do you mean SPY is the strongest? Well, let's go to our notes. Okay, SPY all-time high of the November was taken out in December. So in fact, all-time high in November is irrelevant because we created a new all-time high in December. So that's mean the SPY is actually the strongest. Well, why saying that that's strongest when the Dow Jones is at the all-time high? Yeah, but the Dow Jones did not take out the November high, you know. But it's interesting, this year the Dow Jones is still holding up like a champ, and I'm going to point out this to you in a moment. By the way, these notes are the notes that I was saying to you that I'm going to post a little bit later on at the end of the session, right here under the Ask the Question. So you would go there, you would look at the January 8 notes, and everything is going to be there. So you will have access to these things, and especially once when I start building an option trade, which is going to start in like a few seconds here. Okay, so without any hesitation, I want to minimize this and bring up the diamonds. So I'm bringing up now the diamonds, and I want you to observe the bar that we are looking right here on a diamond. Let me just get rid of this. The size of the bar on a diamond for the last week that is being represented in our case as an actual monthly bar is quite small, which means if I'm going to short one of these markets, would you agree that I'm not late on the Dow Jones, but in terms of me jumping in on a QQQ, I'm already late? So feel free to use the chat, and while you're doing this, what I'm going to do right now, I'm going to tuck away this, and I'm going to pull up the options with options, and I'm going to look at daily charts on the diamonds to get a little bit more in the detail. And by the way, for those of you who are using Tradictive, I want to show you the last piece. How do you save this? You simply go here, save page as, and I like to name it as the number 4 because that means 4 charts, and I use uppercase N for a monthly. So from now on, if I want to bring that particular chart back in, I just go where it says open page, and the one that I created is 4M. Of course, when I was practicing it earlier, I named it 4 monthlies, but that's way too much spelling. So what we can do with that, we can just simply delete that one, and now we know that we have a 4 monthlies. Okay, without any hesitation, I want to now look at the daily. So I have looked at what the week has done in the terms of, and I'm going to capture this one more time before I do anything else, and I'm going to use orange for every one of these. So the size of the bar on the diamonds is very small. The size of the bar on the QQQ points out that it virtually encapsulated the whole movement of the December. So we're definitely late on the Qs. You can make an argument that we're not late on a Russell, but the problem with the Russell, that Russell goes sideways and there's no action for us unless we take out that low, and that low is at 208.76, and I'm going to share with you in a moment what I'm going to do with that. And S&P, well, S&P is somewhere in between the Dow and let's say the Russell. But still, the one that I want to consider the short trade is the one that I'm not uh, late yet. So I'm hitting the escape button. I'm opening the new page, options with options, and I'm gonna now change the ticker to diamonds. And when I change the tickers to diamonds, I want you to notice the outer climate. The outer climate here, it has a 9-day exponential moving average, and we are barely below it, which is really, really good for me to know. We only have a so far one down day, only one down day, which is very much unlike the rest of it. And we still have a calls that are higher than the puts. We'll come back to this in a moment, but what I want to do right now, I want to compare it quickly with the SPY, so I no longer then waste time on any of this. And I said I have selected the one that I really need to trade, and that is going to be the diamonds. On the diamonds, we are only one day into the red climate, while on the S&P we have violated the 9-day exponential moving average quite significantly. As you can see over here, we've been down below it for 2 sessions, plus we have had 2 auto climates over here that are below, and calls and puts are still looking good, right? So let's look at the QQQ here, and then the IWM, and then we're gonna move on to the option universe. So the QQQ had 3 down days, while the IWM has 2 down days. So what we are now trying to do here is very, very simple. We're trying to come up with the option trade that makes the most sense. So finding the short trade that aligns with the UFO is what our goal is. So what I'm doing right now, I'm going back to the diamonds to kind of visually present to you what I would like to do. And it's going to be not one option strategy, but there's going to be 2 option strategies, right? We have a red UFOs right here in this area around the 368. So I would like to place, and I know this is a new term for a lot of people who have never traded options, a bear call spread. And I'm going to feel comfortable placing the bear call spread right at this level right here. But at the same time, I would like to have a target if the price action moves lower to about the 360. So having said that, I want to just kind of capture the few things that need to make sense before we start building this trade in this last half an hour that we have. And one of the things that it's going to really help is if I, in this Word document, simply add 3 columns. And the 3 columns that I'm going to add are going to be calls, strikes, and puts. Okay? So when I create these things and I focus only on one side, which is going to be 368 in relationship to the current price, which is at 362. Where I'm getting these numbers from? I'm getting these numbers right here. So 362 is where the currently the Dow is. So when I know that the 362 is where the currently the market is, I can highlight that in yellow just to kind of keep in mind that this is a call, and call is going to have a value only if it goes to, let's say, 361, or if it goes to 360. Okay, so in those cases, then it's going to have a value, intrinsically speaking, right? So if the price drops from 362 to 361, then that would be what is called in the money. The next one is going to be then 2 steps in the money. Then what is this called? This is then called at the money. And then the one up here that is a 363 obviously is going to be called out of the money. The one above is also going to be out of the money. The one above is also going to be out of the money. The one above is also going to be out of the money. So all the way to 368. So what I'm planning to do is call a bear call spread. A bear call spread involves selling an out of the money, and in our case, it's a 368 call, and simultaneously buying the higher one, and we can buy the maybe 370, right, to pay for the one that is at 380. So I'm going to stop on this, and then later on I'm going to work on the puts. So having kind of presented the idea of what I want to do, I'm going to now bring up the option chain. So the option chain that I'm going to bring here is going to give me example of the options. But options that I really want to look at are the ones that are listed here. But before that, I want to have a very, very clear goal. Where do I want price action to go? I want price action to go to these green UFOs. So one of the powerful thing of the Tradictive option planner that I can place the mouse on an area that I want it to go. I single right click, and then when I scroll it down all the way to the send to, I have a strategy builder right here that is going to show up. So without any hesitation, I'm going to give you the first golden nugget. Okay, this is a golden nugget of this platform. This golden nugget is very, very simple. The golden nugget means you select on the chart target, and then you single right click, and then you go send to, and then you select the lowest possible choice, and it goes into the strategy builder. Okay, I'm sorry, I'm trying to type too fast here. So okay, so one more time, what am I showing here? I'm showing the area of the 360 is my target. I single right click, I go where it says ascend to, I go to the strategy builder, and when I click here, what is going to happen that I'm going to have a strategy builder. But what is really interesting here, if you observe, there's a lot of numbers here, and many people can feel intimidated by it. But the one thing that really, really helps, that it gives me the target date, by which date we are going to arrive at the target. So statistically speaking, we should arrive at the target by the January 16th. So that piece of information is very crucial to me when I'm selecting which cycle of options I'm taking. So one more time, I'm going over here where it says a chain. It has given me a lot of different choices of the options. And if I select the January 21st, that would be the correct choice that I'm selecting. So I'm selecting the January 31st. So I want another thing to be observed, that we have here the strike prices that are visible for everybody to see. And the strike prices are right in this column. I'm going to use a blue to be a little bit more obvious. And these are the choices that I need, right? So in case I need strike prices 368, what I can do right next to my selection, which means I have deselected, I don't need any other cycles. I only need the cycle for January 21st because I'm giving myself a little bit more time. And here from all the different strike prices, what I want to do, I want to actually select some of the strike prices that make perfect sense for us, right? So those that make sense for us supposed to be 368. So 368 is the one that we are going to click as a seller at a bid. And the moment I click that, there's going to be bear call spread that is going to be created right here. So this bear call spread that is being created right here, and let me now use green here so I can make this a little bit more obvious. So I have a same expiration for both of them. I'm selling the one, and then I need to adjust what am I doing with the other one. And one of the easiest way for me to do this would be simply to click edit the spread and to say, yes, I want to sell the 368 because that's what the chart is supporting me. And let's pick the one that is a higher, which is a 370. So 370 is the one that I'm buying, which obviously would be higher than the one that I'm selling. So this is the one that I'm selling. So I'm selling the 368 call, and I will be then adding the sell right above. So I will not do anything with the 369. I will not do anything with the 369, but I can add one more sell above it because this is the one that I'm going to be then buying. So I'm going to be then buying the 370 call. 370 call, right? So in that case, my bear call spread would be risking the $200, and it will be giving me a credit that I'm going to use for the financing of my put, which I'm going to come in a moment, because this put is what I really want to do because I'm overall bearish on a trade. I'm bearish on a trade. So I'm selecting this to 370. I click OK, and I notice that I'm getting the 64 cents of the value. So now if I know that I'm getting the 64 cents of the value and I'm risking about the $200, right? I now need to move on to the put side to know actually what I'm going to do with the puts. In terms of the puts, I would need to buy the put down here. So if I want to target to be 360, that's my target. So I want this thing to drop to 360. Buying, let's say 361 put at the ask is going to cost me something. And because that's going to cost me, I would like to have my bear call spread finance buying of the put. So what I'm going to do right now, I'm going to add one more leg here. When I go edit the spread, I'm going to add one more option leg. I'm going to change the call into a put, and it's going to be a buying. So we are buying, and we are buying a put. And we said we're going to do the 361. So when I click here 361 and click OK, I will notice that that particular cost is $291, already counting that I have received the 64 cents from the sale. So now the question that every investor and every trader needs to answer: how much money do we want to invest in this particular trade? And one of the rules of the thumbs that I like to use, that it helps me a lot, is if I look at the current price. If I look at the current price, and the current price of the Dow Jones is around the 362, and if I want to go ahead and invest the $1,000, with the $1,000, I really think that you can only buy 3 shares of the diamonds. Just 3 shares. That's all that you can do with the $1,000 that are available. So $1,000 that are available to invest is really not that much, which means that in my case, my bear call spread that is right now composed of, and I'm gonna present it from the top to the bottom. So I'm buying to open the higher one, which is the 370 call. I'm selling to open lower one, which is a 368 call. That ties up about $200, right? For one contract. And it produces me a credit of the 64 cents. 64 cents. But if I do 5 of these, then what would happen? Well, in that case, I should be ahead of the game. I should really be ahead of the game. And in that case, it's going to really work out for me, because in that case, I'm going to just bring the calculator here so it can kind of help to solidify this math. So if I had a $1,000 invested, right? And I went ahead and I bought $362 underlying with $1,000, I would be able not even to get the 3 shares, only 2 shares, right? But I'm using here $200 and getting the credit of the 64 cents, right? And I know my put cost me quite a bit more. So if I have now 64 cents and I'm going to do times 5, because of 5 times 1 is still $1,000, I'm going to be getting 320, which means this 320 would be able to pay off for my put. So let's now go back here and bring up again the 361 that cost me $3.80, right? So that's the one that I want to finance. So I'm going here again to the edit spread, and I'm going to change the value to 5 contracts on each of them. So that's mean 5 bear call spreads should be paying for the one put of the 361. And when I click OK, you would see now only thing that is out of the pocket for me, and I'm going to circle it right here, is $35. So I wasn't completely able to knock it off, but I'm now following all the rules. So I will go again slowly, piece by piece on this. So you will need to follow along, and that's why I said, like, later on after the session, I'll post all of these things inside. Ask the question, the document is going to be there, and you can look at it. So there's a couple of things here that I want you to notice. 380 is the cost of my put. So 380 is a cost of my put. So when I have here the trade, and this is a trade, so buying of the put, and we're specifically saying 361 put at the debit of the 380. So now we know that put cost 380. And one more time, to make this more visible, I'm gonna pull up the option chain and show out this green box is what matters, right? So that's 380. That 380 right there is being financed with 5 of these bear call spreads, and each of them is giving me 64 cents. So that's 64 cents times 5 gave me 320. So let's now put this in the writing so there can be no confusion about what is going on here. So my bear call spread that involves the 370, 368, it ties up $200 for a spread, okay? It gives me a credit of the 64, okay? For 5 spreads, that credit is going to be 0.64 times 5, and we said that we were able to get the credit of the 320, So now the bottom line is, this is in one sentence, what I'm trying to teach this morning is that my debit is financed by the credit. In other words, my long put is paid for by 5 bear call spreads that are how many points out of the money? If we are here at the 362 and I'm selling the 368, they are $6 out of the money. They're $6 out of the money, while my target is just about $2 lower. $2 lower. Now, having said that this is a trade, I want to emphasize to you that this is how I want this to come into the play. I'm bringing here Thinkorswim, and I want to teach you how on a Thinkorswim you can enter the symbol, and then when you go into the alerts, you can say, I want to create an alert when the diamond is at or above. So when the diamond is at or above the certain level, you want to get triggered. But it's not just the diamond that needs to get triggered. It's not just diamond that needs to get triggered. We want to see the SPY collapse. We want to see the IWM collapse, and you want to see also the Russell to collapse. So then the key level that needs to be taken out are the same levels that we were talking about earlier. And those levels are shown right here. And I'm going to open up again. I'm going to just X this thing out. And I'm going to open up again that page that we used earlier. And those levels were actually, I have it recorded right here. I can just type it in and show you the levels that we need to have, right? So for a SPY, when the price is below 448.92, okay? When IWM is below 208.76, and when 377.47, let me just double check, are those numbers correct? Open page, 4 monthlies, loads up. Yeah, so the QQQ, this line is at the 377.47, which is very much what we typed in. 377.47, IWM, and a SPY, right? So when we get triggered that the price is taking out the monthly QQQ, when the IWM is taking out the monthly, when the Russell is taking out its monthly, and when the SPY is taking out monthly, then the diamond that is currently, it appears, one of the strongest, has almost no choice but to follow it. In that case, I would jump in. I would sell 5 bear call spread to finance the cost of the put, cost of the put. So one more time, I just want to emphasize that the best use of this platform is when you select the target and you single right click on a target and go down here and it says go to the strategy builder. So one more time, single right click on a diamond, wherever you feel that the target is, go down, select it. When this thing appears, it will predict to you the target date where the target is going to be achieved. Once when you know that, then you can go into the option chain and say, instead of having the multiple expiration, I'm going to select only the expiration that I want. And then from that point on, you are using over here a builder that you have selected. In our case, we were using the bear call spread builder. We were editing this to the correct strike price, which was the 368 was the one that we sell, 370 is the one to buy, and then we were adding one more leg, but that leg was buying of the put on the same cycle, but it was a different price, and that was 361. And in that case, I didn't have to do much math because all that I did, I click here, OK, and I was looking what was the cost that I need to come up with. So this cost was when I have the things proportionate 1 and 1 and 1. But I don't want to have a 1, 1, and 1. I want to have a 1 put, but I want to have a 5 of the bear calls to reduce my outlay of the capital from $291 to virtually less. So what I did in that case, I have edited here to 5 contracts, to 5 contracts, and then when I click OK, over here, out of the pocket cost is $35. So to summarize this, because we are now on the top of the hours, I want to encapsulate this. So we have about the $1,000 invested as a margin to hold this 5 bear call spread. And the extra money that we need to come up with is about $38 of the debit in order to pay for that put. And because we're now running out of the time, I'm going to stop this, but I will be with you on Tuesday in a live session and I'll go over this. So one more time, I want to thank you for attending this. Sorry for a little bit of technical difficulties at the beginning, and I want to wish you all the best.